for joining me now via Zoom to look at this and, of course, born in economic issues. She's a senior associate financial advisory at Deloitte, Ms. Temitope Olugbile. Good afternoon. It's good to see you today.
Good afternoon. It's a pleasure to be here.
Yes, I want to start this way. Make us understand what it means for a country to have a solid external reserves. What does this really mean for a country? For example, Nigeria, what do you think would be a good solid external reserves rate for us, and what do you think this would do positively for the country?
Okay, so before we come to what would be a good threshold for external reserves, we might want to first look at the importance of external reserves to a country. So, different countries keep their foreign exchange reserves in different forms and for different reasons. But for Nigeria in particular, there are certain reasons why there's a need for a strong external reserves level. So the first thing is as a buffer. So for a mono commodity country, an economy like Nigeria, it's important to have a buffer that would help when economic crisis comes, right? So being a mono commodity country, the fact that the one commodity we trade a lot is crude oil, which is a very cyclical market, meaning that prices are up today and down tomorrow. So it's important to have a buffer for when crude oil prices globally crash, so that you don't find yourself. Historically, what has happened is when crude oil prices crash, we then have foreign exchange access and liquidity issues. So that's why it's important to have a buffer ahead of time to proactively manage such crises. Then also external reserves is an indicator for foreign investors a lot of the times, because what has happened historically is that investors bring their money and find it difficult, again, which is pointing back to our foreign exchange market challenges, find it difficult to access. And there's also sometimes they've had foreign exchange liquidity issues when it's time to repatriate their funds. So it's an indicator for investors a lot of the times as to the economic soundness, of your policies and a reassurance that they are going to get their returns in time. There are also other uses of external reserves, for meeting your international payment obligations, your import obligations. So there are different reasons. To the level that it should be, so there's something called an import cover. So what an import cover means is that if in the event that there is no foreign exchange inflows, you have no foreign, how long can the current levels of your foreign exchange reserves, how long can they carry you? How long can your economy function in the event that there is no source of inflows coming in at all? So I think it's important for Nigeria's external reserves level. The guide will be for you to have for you to be able to cover imports and other obligations in the event that there's no foreign exchange inflow. So you want to match it against globally prescribed imports cover levels. That should be where your foreign exchange level should be. Something that can cover you for at least a good amount of time.
Brilliant stuff there, Temitope. Now, the ongoing conflict, of course, between Russia and Ukraine, almost affecting all that we talk about in recent times, has put forward a pressure on global energy and commodity prices, and of course, inevitably feeds into the inflation basket, complicating likely MPC decision, which is very important for us in this part of the economy. Now, with all of this, let me ask you, do you think that the Monetary Policy Committee would shift their stance? They've done this for more than how many meetings? I won't be specific, but it's been a while. Do you think that they would try to shift to look at what we also have on the side of inflation?
Given that the committee's primary mandate is to control inflation levels, it's important to understand what is happening when it comes to domestic inflation. So like you mentioned, there is, on one hand, there is the Russia-Ukraine crisis, which has affected, a lot of African countries because of the interaction points we have with one of these conflicting countries, which is Russia. So, one interaction with Nigeria, African countries, including Nigeria, has with Russia is through the supply of commodities such as wheat, which is an important input for, a lot of manufacturing for FMCGs, right? So, given that there's that disruption in the supply of this key commodity, there is, there's already a break in the food supply chain on that angle. Now, if we look inwardly, before even the Russia-Ukraine crisis, Nigeria's agricultural produce was already going through some challenges, and these challenges cut across, the entire value chain. So if you start with production, for instance, you see that your insecurity challenges is affecting farmers from going to the farm. Recently, given the fuel scarcity and price increase, we see even to the distribution, there's the transportation cost that is affecting the distribution. Also affecting distribution is the lack of infrastructural facilities like your storage facilities, which often leads to post-harvest losses. So there's all of these challenges that were already existing even before the Russia-Ukraine crisis, right? So there is definitely upside risk now, more preparing for inflation. And even in February, we see that for a second time, we saw that there was an increase in inflation rate in February. So there is risk to inflation, right? Currently, there's risk to domestic inflation currently. Now to the MPC, and what the MPC is looking at, central decision was to hold rates constant. But if we look closely, we saw that about 4 members actually voted to increase benchmark interest rate by as high as 50 basis points. So it appears that there's some kind of shift, a little bit in, stance, given in the monetary policy stance, given the upside risks, and, given also what other economies are doing. I mean, if we look just a stone throw at Ghana also increased their benchmark interest rate at their last meeting quite significantly by 250 basis points. So we see that these happenings are starting slowly to affect, monetary policy committee members are starting to consider these factors a lot more than they were doing, so it is likely that, we might see a change in the policy stance in coming meetings. But for now, I mean, they chose to keep it constant and still observe the inflation trend. And by the next meeting, we'll be able to see if this increase is a blip or if it has become a trend and, there's no more decline in interest rate, but we're back to inflation rate, but we're back to an increase in inflation rate. So they'll be able to consider all these factors at their next meeting.
Of course, some risks are posed to developing economies by monetary policy normalization on one side. But let's look at issues like capital flow volatility, exchange rate pressures, and of course, rising borrowing costs on international debt market. I would like to stay a little bit with the exchange rate issue, and managing it properly is something that we need at this time if we are to encourage foreign investment. You talked about the fact that this is one of the indicators, talking about external reserves, indicators for foreign investors. So how well would you assess the management of FX, and how can we do better than we are at this moment? Demand and supply is what some people are saying is the way to go.
I mean, that's the central of most economic related issues. It's really to do with the demand and the supply. So on one hand, we are having, given the Russia-Ukraine crisis, there's an increase in global oil price, and that's affecting our revenues. So on that hand, we're expecting increased revenue from the increase in global oil prices. But the demand, I think more than anything. So before I leave the supply issue, there's also the need. Like I mentioned, oil is such a cyclical market. So if we're to manage our forex effectively and efficiently, there's need to diversify forex inflows away from this one commodity that is in a cyclical market. That any change in geopolitical happenings or events, and the oil prices could tank and crash sharply. So we want to also diversify the supply streams away from oil, from just predominantly oil. On the demand side as well, so it's in the managing of the demand dynamics, because we're such an important import dependent country. We have this demand from literally so many sectors and industries. So it's the manufacturing industry. There are so many other industries that depend on the import of one input or another. There's FMCG. So to import these inputs, they need forex. And if we are to manage the demand dynamics in the long term, we also want to consider local substitutes to these inputs that these industries are seeking and abroad, right? You want to be able to give them local options that are as high quality as the ones they are getting abroad. That's in the long term. In the short term, you want to also manage these demand dynamics in such a way that there is easy access and liquidity, right? Which, I mean, you have to credit the CBN for doing, because what they're trying to do is to manage the access such that people, with legitimate business reasons are able to get this the dollar that they need. But we might also want to consider expanding the scope in a sense of where businessmen and women can get forex from. So that's another thing to consider in the short term, such that way it's not solely dependent on the commercial banks, which is the current state now. So dependent on the commercial banks, which leads to long queues, long processes, and delayed trips, and which ultimately affects your economic activities. So those are things to just manage and control on both the demand and the supply side. If our foreign exchange market is to give investors that what has happened before, in that investors' funds are in a sense trapped and they're unable to repatriate repatriate their profits because there's no liquidity and there's no access. They want to be assured that would not happen if they bring their foreign inflows. So it's the impact of your efficient management of your foreign exchange market is having on investors coming into your country. It has to be looked at and addressed accordingly.
Before I let you go now, Temitope, I was thinking, and a lot of discussions has been around Nigeria trying to improve exports, now not imports. That's, we have to improve local production so that if we export, we'll make more of forex. That has always been the discussion. And we see the CBN trying as much as possible to improve local production across all sectors, pharmaceutical, creative. We can go on and on. Agric is already known. We see what's happening with rice, maize, and all of that. But what's your assessment? We are yet to be sufficient, and we are thinking export. So which comes first?
Okay, so in addressing that, what I would just say is, so before the discovery of oil, agriculture was, the focus sector. So if we look again to this sector, agriculture, as a source of, as a way of diversifying our revenue away from solely oil, we see that, so yes, the CBN is doing a lot of things, laudable interventions, and programs, Anchor Borers program, and so many other programs like that, to be able to get the export proceeds, as much export proceeds as we can get from these commodities that we have a comparative advantage in, right? But beyond the access to finance for many of these farmers, if we look at what's happening in food producing states, I think it goes beyond, a lack of access to finance. There are some fundamental and structural issues that need to be addressed if we're going to be able to import commodities that are of high quality, because also what we find sometimes is our commodities are not of good quality. So if we're going to be able to address these challenges, there are insecurity challenges, there's the infrastructure challenges, that affects, the entire value chain. If you want to reduce post-harvest losses, for instance, you need good storage and transportation infrastructure. So there are these structural issues that, like I said, goes beyond an access to finance that also needs to be addressed alongside the challenge of access to finance. So addressing these challenges have to go hand in hand in order to be able to get the optimal export proceeds we require.
So wrapping up now, what are your expectations considering all that we see? Of course, with regards to economic recovery, it's still a major concern. We see our debt servicing rising as we move on. So what are your expectations?
So expectations, especially as we wrap up the first quarter. Economic-wise, I think, if we start with GDP, I think activities such as, the fuel scarcity we saw this quarter, the Russia-Ukraine crisis we saw this quarter, the increase in transportation, all of which, disrupted, give or take, activities across a number of sectors. There's also the epileptic power supply, that's affecting of companies across different industries. So I think the GDP for this quarter would be very reflective of these activities. And if we take inflation as well, we also expect that the disruption in the supply chain as well would of imports of commodities we get from Russia would also affect our inflation. Is, like I mentioned, there's already upside risk to inflation, and given what happened in February, we're yet to see if that's a trend or if it's just a one-off. So what we see in March will determine that. So these are some of the indicators, and these are some of the outlook on these indicators. Foreign exchange as well. If we are able to manage the demand-supply dynamics, we expect that would stay stable. And foreign exchange inflows, we also, as much as we can manage our forex market and the insecurity challenges and other structural issues and fundamental issues investors are looking out for, given it's a pre-election season. So these are some of the factors that would affect economic indicators as we wrap up the first quarter of the year. By and large, we are recovering very strongly from the pandemic, and we expect the recovery to maintain.
Brilliant submission. I must thank you so much. I've been speaking to Ms. Temitope Olugbile, she's a senior associate financial advisory at Deloitte. Thank you so much for spending your afternoon with us. I know you're very busy, so let me just let you get back to work. We'll see some other time.
Thank you very much, sir. Bye-bye.